Hi guys, welcome to the Savvy Money Show with me, your host Sean. Sorry, we are outside, so there will be some background noise. We're discussing Marathon Oil. I know I've done a video about it before. I've been asked to update it. Now, you can see there, it's near low, maybe because it doesn't pay a dividend, but it's also because it's not profitable. Now, it's reported a loss in Q2, and people want to know about the Speedway deal, which I spoke about before. Now, we are going to here. First of all, it's posted a smaller than expected loss on Wednesday, as it reined in costs to cushion the impact from COVID-19 pandemic. Now, it's cut its costs and expenses by 17% to $975 million. That's good, but it's still not profitable. Now, the thing is, what they're saying is you would probably be better off looking at Psth, who has done a better job. Now, people are thinking we go into it because of the Speedway deal, and the thing is, it's not the only thing. Workhorse completes the acquisition of Marathon Oil's UK business. It struck the deal in February, so it's paid $75 million for the assets. Now, you have to wonder if they're going to have enough assets to be worth investing in, even if oil does come back. Now, you have to think, are you going in just because of the Speedway deal? Or, because if that's the case, they're set to sell it for $21 billion to 7-Eleven, and $21 billion would be good. It would this, I mean, who wouldn't want to suddenly get 21 billion on their cash, cash on their books? For the last quarter, they have reported a profit, but they haven't reported profit for the year. So you have to wonder, with this, will they be paying a dividend for the first time to the shareholders, or will they be doing the right thing and reinvesting into the company? We traded up 4%, but then you have to think to yourself, is it enough? They've lost their UK side of the business, which was a huge side, and before they announced the Speedway deal was back on, let's face it, we all knew it was back on. Then Goldman Sachs had, sorry guys, I've gone past where I need to go. Goldman Sachs had already cut it to sell. Nah, but they put it with a $6 price target. No. You have to look into it and wonder whether or not this is going to be a valid business going forward. They're selling all their property to 7-Eleven, all their gas stations to 7-Eleven. They're selling their UK arm to another oil company. They're not going to have much left. They're going to have the money to stay afloat, but at the same time, they're not. How long is that going to last them at the current burn rate? But you've got to think about. What they should be doing is using that money to reinvest and invest in the future, so they don't become dinosaurs like the oil they drill up. Now, it's what happens next that you've got to think about. Will they? It's a will they, won't they situation. Will they use the money wisely and will they use the money wisely and invest maybe in renewables, and diversify their company, or will they go for other oil fields? Personally, I think the only saving grace for this company is going to be if they invest heavily in renewables. They would then have a finger in every pie. They would have the US oil. They would have lost the gas stations, lost the UK arm. But to countermand it, they would have. Had gone into renewable, and that is going to be the future. So it all depends on what their plans are with the money. If they just leave it in the bank account and it's going to be a waste. I understand if they want to pay off debt, that would be fine with me as well, or pay down debt, but or get a better interest on their current debt with the money. But they can't just leave it sitting around. In my opinion, I wouldn't start a dividend now. They haven't started one for a long time. They've lost a lot of assets with this deal. They lost a lot of assets with the UK deal. They've got to reinvest that money somewhere. If they don't, they're done for. I know they made a profit this quarter, but it's one quarter. There's plenty of companies out there at the moment you can pick up cheaply, and they need to capitalise on it. I'd like your comments, and I'd like to know what you think on it. To tell the truth, this is one that intrigues me, because this is what I'd call a super spec play. The board, if I get into a speculative play, it's usually because the board and the CEO there's something about them. They have a track record, or they have a concept. Sorry about that.
And don't forget to hit that lovely like button, almost as lovely as me. Helps with the YouTube algorithm and getting the video out to more people. And don't forget to hit that subscribe button if you haven't already. Become part of the Saving Money Show family. We give each other hints and tips and updates about stocks and shares we talk about on the show. As well as that, you can ask me to look into any share you want, and I don't charge a Discord fee or ask for a Patreon. All I do ask is for you to comment in the box below and hit the like button. Even if you disagree with me, especially if you disagree with me, I like a debate. And if I do something wrong, I want you to call me on it so I can improve the channel. And why not check out the links in the description below? There's lots of others. I've used each one of them myself. I wouldn't give you links if I haven't checked them out myself. If you're looking for a free trading platform which should trade your stocks and shares, you know, you can get a free share worth up to £200 for signing up and depositing a small amount. A free trade only requires a £1 deposit. The others require £100 or dollars, depending on which one you go for. Stake has over 3,500 US stocks on their books, which is the biggest one outside of the US. Whereas Trading 212 is one of the best and easiest platforms to use. But as I said, I use all three. Anyway, on with the show.
This board don't have that. This CEO don't have that. You know, they don't have a great track record. You know, they've seen a decline. You know, it's been very rocky. Now, you may get into a company because the company's stable. This isn't that company. You may get into a company because it has a dividend or it's dividend growth. This isn't that company. Or because it's struck profit. This isn't a company. Because it's only done it for a quarter, not for a year. Or because of its growth. This isn't that company. Its growth has declined because it's just sold off its growth areas and it's stuck with areas that don't grow. So with this, it's a gamble. You're gambling. It has hit profit, but then as soon as it's hit profit, it's sold off its areas. It can hit profit again. So you basically want them to hit the ground running as soon as they get the cash, go out and have in their mind who they want to acquire and who they want to spend that money on, and go out and get a great deal with someone like Lululemon did with Mirror Mirror. That was an amazing deal, and you would hope they could do that. If they don't, that cash may last them a year, 2 years top, and during that time you'll see your share price decline. I know it's only a small amount at the moment, but you have to decide whether it's worth the risk. Anyway, we're going to move on, and we're going to not there, sorry. What am I doing? I'm going the wrong direction. One Life Healthcare. Now, we look at Live On Go and the Teladoc acquisition. Now, I think One Life is... I said about this before. I said how Teladoc is a better company, but One Life is a better value company. Look at that, for volume, how many shares they have. So, now, I know it's not profitable, but it won't take long. And this is a company that does the same thing as Teladoc. You'll find that it won't be long before it actually becomes it won't be long before it becomes as big as Teladoc or gets acquired by someone like that. Now, next one, Silvergate. Now this is a company, unfortunately these are companies that aren't available in Trading 212 or Free Trade, so until they are I can't pick them up, but that doesn't mean you can't make out of them. Silvergate Capital Corporation. Now this is another company that is profitable, but I think you could 3x or 4x your money with. I think it's one worth doing your research into, and I think you'll be surprised. Now, I was asked to look into a couple of companies before. Illumina, I've done a video about, and I won't spend too much time on it, but when it was 300, between 289 and 300, I said when a company owns 90% of the market and is allowed to keep 50 to 75% of the data from its machines, then it will only grow. Even in a market that's not as well versed as this. It's gene sequencing. I think Illumina will go from strength to strength. The reason it is its high price target. If it did a split like Apple, you will see this soar. They don't want to do that. They want to become like the Amazon of the healthcare world. They want to go for serious investors only, and I understand that, but the problem is it keeps out investors who want to go in it. If they were down at $100, and I would be piling in. Instead, I just have my few shares in it. I went in sub $300 when I did my video, and I still think there's room for this to grow. Is it overpriced? Yes, but what people are missing out is this is a growth stock. This is one that won't stop growing unless they outlaw what they're doing. So I'll see you in the next video. Don't forget to hit the like button down below, and don't forget to comment in the box below. It really does help with the YouTube algorithm. I'll see you later. Stay safe, stay savvy, stay invested.